Hello and welcome back to the deep dive. Today we're jumping into a really fascinating topic, artificial intelligence in finance.
It's definitely a big one. Huge changes happening there.
Absolutely. We've gone through the materials you've sent over, and the plan for this deep dive is to, well, pull out the most crucial insights about how AI is really reshaping finance right now in April 2025.
Yeah, trying to cut through some of the hype and get to the core of it.
Exactly. We want to understand the main applications, the benefits, but also the challenges without getting, bogged down in a super technical jargon. Hopefully you'll walk away with some clear takeaways, maybe even a few aha moments.
Sounds like a good plan.
Great. So let's just dive right in. To start us off, could you maybe explain what we actually mean by AI in finance and why has it become such a big deal lately?
Sure. So AI in finance, it's essentially applying these advanced artificial intelligence techniques, things like machine learning, deep learning, NLP, natural language processing within the financial sector. It's a big slice of the whole fintech pie, really.
Okay. And what's the goal? What are financial institutions trying to do with it?
The goals are pretty broad, actually. It's about analyzing just massive amounts of data, automating tasks that used to take ages, making better, faster decisions, managing risk more effectively, personalizing services for customers, and a really crucial one, fighting financial crime.
Okay, could you give us maybe a couple of quick, concrete examples? Like, how does this actually look in practice?
Yeah, absolutely. Think about fraud detection, for instance. AI can spot a potentially dodgy credit card transaction almost instantly, way faster than older systems. It looks at your patterns, the location, things like that.
Right.
Or in trading. AI algorithms can execute complex strategies based on market data in fractions of a second. Humans just can't compete with that speed.
Okay.
And assessing credit risk. AI can look at way more data points than just a simple credit score, potentially giving a more, nuanced picture. Plus, things like robo-advisors giving personalized investment advice. That's AI too.
That makes it much clearer. So what's really pushing this forward now? Why the sudden, or maybe not so sudden, surge?
It really boils down to data. The sheer explosion of data. Volume, velocity, variety, all of it.
Data.
Every day, finance generates just unbelievable amounts of information. Market feeds, transactions, customer interactions, news, social media. It's overwhelming.
Too much for traditional methods.
Exactly. Traditional analytics just can't keep up. AI gives us the tools to process it all and, crucially, find the valuable insights hidden in that noise. It's like needing a much bigger, smarter sieve for panning gold.
And how important is this for, say, the Canadian financial scene specifically?
Oh, it's critical for Canada. For our banks and financial institutions to stay competitive globally, absolutely, but also for things like security helping agencies like Fentry fight money laundering and managing risk, which regulators like OSFI are obviously very focused on. Plus, just meeting customer expectations. People expect smarter, more personalized digital services now,
Yeah, that makes sense. The sources we looked at really hammer home this point about data. You've touched on it, but can we unpack that a bit more? Why is data so central here?
You're right. It's impossible to overstate. Finance is data, fundamentally. And AI's power comes entirely from its ability to crunch that data in ways we couldn't before. Scale, speed, complexity.
So it's about the characteristics of the data.
Precisely. Think about the 5 V's they often talk about with big data, especially in finance. First, volume. We're talking petabytes daily. Transactions, market data, customer info, it's immense.
Petabytes, okay.
Then velocity, how fast it comes in. Market data changes in microseconds. Fraud detection needs real-time analysis.
Right, speed matters.
Third, variety. It's not just neat rows and columns. You have structured data like transaction logs, yes, but also unstructured stuff. News reports, emails, social media posts. AI needs to make sense of all of it.
Okay, so structured and unstructured.
Fourth, veracity. The data has to be accurate, reliable, garbage in, garbage out, especially in finance. And finally, value. That's the whole point, right? AI helps unlock the immense value hidden in all that data, making predictions, managing risk, spotting fraud, automating things.
That's a great framework, the 5 V's. Okay, let's zoom into some of those applications. You mentioned fraud detection earlier. It seems like a really big use case. How exactly is AI changing the game there?
It really is a cornerstone application. AI allows for real-time, or very close to real-time, identification and often blocking of fraudulent activity. It's much more proactive than waiting for someone to report something's wrong.
So give me an example. Credit cards.
Yeah, credit cards are a classic. AI looks at your normal spending, where you are, the type of store, the device you're using, your history. If a transaction suddenly looks way out of character, boom, it gets flagged. Maybe even blocked before the fraudster can complete it.
Much faster than getting a call a day later.
Exactly. Then there's anti-money laundering, AML. This is huge for banks and for regulators like FinTrank here in Canada. AI can detect really complex, subtle patterns across many accounts and transactions that might signal laundering attempts, things humans would likely miss.
How does it do that? Spotting networks.
Yeah, techniques like graph analytics are really powerful here. They map out connections between accounts and transactions to find suspicious networks. It's quite sophisticated.
Okay. What about other areas like insurance?
Insurance fraud, too, definitely. AI can analyze claim details, the claimant's history, maybe even cross-reference with other data to spot patterns that look suspicious. Things like inconsistencies or unlikely scenarios.
Right, and identity theft, account takeovers.
That too. AI monitors login attempts, changes to profile information, unusual transaction patterns after a login. It looks for anomalies that suggest someone else has gained access to an account.
And what are the sort of the AI techniques behind this?
Primarily, it uses supervised learning, where the AI is trained on lots of examples of known fraudulent and legitimate transactions, so it learns to tell the difference. But also unsupervised learning, which is great for spotting new types of fraud because it just looks for anything that deviates significantly from the norm, from the expected patterns.
Fascinating. Okay, let's shift gears a bit. Another major area highlighted was algorithmic trading and investment management. How is AI transforming the markets and how people invest?
Fundamentally, AI is all over trading floors, metaphorically speaking, and behind many investment platforms now. It's analyzing market data, predicting price movements, executing trades automatically, optimizing portfolios.
So like high-frequency trading, is that AI?
Yes, high-frequency trading, or HFT, heavily relies on AI and quantitative models. It's all about speed, analyzing real-time data streams, and making trades in microseconds to capture tiny price differences.
Okay, and beyond just speed, making predictions.
Absolutely. Predictive analytics is huge. Machine learning, even deep learning models, are trained on vast amounts of historical data. But they also incorporate things like news sentiment.
How does that work? Reading the news.
Using natural language processing, NLP, the AI analyzes news articles, social media reports, to gauge the overall mood or sentiment about a stock or the market. That sentiment can be a predictive signal.
Interesting.
They also pull in economic indicators and even what's called alternative data. Things like satellite images to see how busy store parking lots are, or tracking ship movements, trying to get an edge.
Wow, satellite images. Okay. And what about for the average person? You mentioned robo-advisors.
Right, robo-advisors are a key example of AI democratizing investment. They use AI algorithms to understand your goals and risk tolerance, then build and manage a diversified portfolio for you, often at a lower cost than traditional advisors.
And they adjust it automatically.
Yeah, they typically offer automated rebalancing to keep your portfolio aligned with your goals over time. It makes sophisticated investing accessible to many more people.
So what are the core AI methods here? Trading, prediction, advice?
Well, for prediction, you see a lot of time series forecasting. For trading strategies, reinforcement learning is interesting. The AI learns by trial and error in simulated markets, NLP for sentiment, as we said. And supervised learning is used for things like predicting price movements based on various inputs.
Seems like a whole toolkit. Let's talk about risk. Finance is all about managing risk. How is AI helping institutions get better at?
AI is allowing for much more sophisticated, data-driven, and proactive risk management across the board.
Right.
We're talking credit risk, market risk, operational risk, liquidity risk.
Okay, break those down a bit. Credit risk, like deciding who gets a loan.
Exactly. AI can build more accurate credit scoring models. Instead of just relying on traditional credit reports, it can analyze, where ethically permissible, of course, a much wider range of data, maybe utility payment history, cash flow patterns for businesses. The idea is to get a better prediction of default risk.
Could that potentially help people who have thin credit files?
That's one of the hopes, yes. That by using broader data, AI could potentially lead to more financial inclusion, offering credit to people overlooked by traditional models. But that needs careful handling to avoid bias, which we should probably talk about later.
Definitely. What about market risk? Things crashing.
Yeah, AI can analyze really complex relationships and potential spillover effects between different assets or markets. It might spot warning signs of increasing volatility or systemic risk earlier than traditional models would. Think about spotting contagion effects during a crisis.
Okay. And operational risk, like internal screw-ups.
Right. NLP can be used here too. Analyzing internal incident reports, customer complaints, even external news to identify patterns that suggest weaknesses in processes or systems before they cause a major problem.
And stress testing, putting banks through hypothetical crises.
AI really enhances stress testing. It allows institutions to simulate much more complex, nonlinear, and severe scenarios to see how their capital and liquidity would hold up. It gives a more robust picture of their resilience.
So a much deeper view of potential vulnerabilities. Now, beyond fraud, trading, and risk, which seem like the big three, what other interesting applications of AI are popping up in finance?
Oh, there's quite a few other important areas. Enhancing the customer experience is a big one.
Chatbots?
Chatbots are part of it, yeah. Getting smarter, available 24/7 for support, handling more complex queries. But it goes beyond that to hyper-personalization. Meaning using AI to understand individual customer behavior, their financial situation, their goals, and then offering really tailored advice, product recommendations, even customized budgeting tools in real time.
So moving beyond just segments to truly individual offers.
Exactly. Then there's RegTech, regulatory technology. AI is automating a lot of compliance headaches.
Like what?
Things like KYC, know your customer checks, using computer vision potentially to verify identity documents. Also, continuous monitoring of transactions for AML, anti-money laundering. And NLP can help institutions navigate and comply with the huge volume of regulations. Very important in Canada.
Automating the paperwork, basically.
In part, yes, and making it more effective. Insurance underwriting is another area. Using AI to analyze more data points for faster, potentially more accurate risk assessment and pricing of policies.
Okay.
And finally, good old process automation, RPA. AI is making robotic process automation smarter, allowing it to handle more complex back-office tasks, invoice processing, data entry, reconciliations, freeing up people for higher-value work.
It really feels like AI is weaving itself into almost every part of the financial system.
Right.
To make all this happen, what are the key underlying AI technologies being used? You've mentioned a few, but maybe a quick recap.
Sure. The foundation for a lot of this is machine learning, ML. That's what powers most of the prediction, classification, anomaly detection, fraud, credit scoring, market trends. You hear about algorithms like logistic regression, SVMs, gradient boosting. That's ML,
Okay, ML is the workhorse.
pretty much. Then for really complex patterns and huge data sets, you have deep learning, DL, a subset of ML. Think complex fraud rings,
Yeah.
very sophisticated time series analysis for trading, or advanced natural language understanding.
Got it.
Natural language processing, NLP, is crucial for anything involving text analyzing news, reports, customer emails, social media, powering chatbots, extracting meaning from language.
Right.
Computer vision, CV, has its roles too, analyzing documents for KYC, maybe facial recognition for identity verification, processing checks via OCR, and that satellite imagery analysis we talked about.
Okay.
And reinforcement learning, RL, is gaining traction, especially for things like adaptive trading algorithms that learn and improve through experience, or optimizing investment portfolios dynamically.
That covers a lot of ground. Looking forward now, what does the crystal ball say? What's the future potential for AI and finance? Where are things heading?
Well, crystal balls are always a bit fuzzy, but the trends seem pretty clear. Hyper-personalization is likely to get much deeper. Imagine your bank proactively giving you advice based on your real-time spending, or automatically moving spare cash into savings or investments aligned perfectly with your immediate goals. Dynamic products that adjust to you.
A truly personal banker in your pocket.
Something like that, yeah. Continued improvements in efficiency and security seem certain. Even better fraud detection, faster payments, smoother compliance, and using AI defensively for cybersecurity within financial institutions themselves.
AI fighting bad AI.
Potentially, yes. The democratization trend will likely continue too, making sophisticated financial tools and advice even more accessible and affordable through things like robo-advisors.
Okay.
Risk management will become even more proactive and predictive, identifying potential issues, market instability, credit risks, operational flaws, new fraud schemes much earlier, hopefully allowing for smoother navigation.
Getting ahead of the problems.
Exactly. Intelligent automation will keep expanding, taking over more complex tasks, shifting the human workforce towards more strategic, advisory, and relationship-focused roles.
The workforce impact. We should touch on that.
We should. And finally, RegTech and SubTech, that's supervisory technology for regulators, will likely advance significantly. AI helping institutions comply more easily and helping regulators like OSFI or the Bank of Canada monitor the overall health of the financial system more effectively.
So more efficient regulation as well. It all sounds incredibly powerful, but usually with great power comes, well, challenges. Let's pivot to that. What are the major hurdles and ethical considerations with AI in finance?
Absolutely crucial to discuss, and there are definitely significant challenges. It's not all smooth sailing.
Okay, so let's start with maybe the most obvious one. Data privacy and security. Finance deals with incredibly sensitive information.
That's right at the top of the list. AI systems in finance process vast amounts of personal and financial data. Protecting that data is paramount. Institutions need ironclad cybersecurity measures and strict adherence to privacy regulations like PAPITA here in Canada.
And it's not just about breaches, right? It's about how the data is used.
Exactly. There are ethical questions around using alternative data sources, for example. Just because you can analyze someone's social media profile for credit scoring, should you? Where are the lines drawn? Transparency about data use is key.
A really thorny issue. What about bias? Algorithmic bias and fairness concerns.
Another huge challenge. AI models learn from data. And if that data reflects historical biases, say, in lending patterns, the AI can actually perpetuate or even amplify that discrimination.
So AI could accidentally discriminate in loan applications or setting insurance premiums.
Precisely. If the data shows that certain groups were historically denied loans more often, the AI might learn that pattern and replicate it, even if the original reasons were discriminatory. Ensuring fairness, transparency, and non-discrimination in AI outputs is a massive ethical and regulatory imperative.
How do you even tackle that?
It requires careful model design, testing for bias against different demographic groups, using fairness metrics during development, and ongoing monitoring after deployment. It's an active area of research and development.
Related to bias, perhaps, is the black box problem. Explainability and transparency.
Yes, the black box issue. Many sophisticated AI models, especially deep learning ones, can be incredibly complex. It can be very difficult to understand exactly why they made a specific decision.
Like why a loan was denied.
Exactly. And in finance, you often need to justify decisions, both to customers and regulators. If you can't explain how the AI reached its conclusion, that's a big problem. There's a huge push for explainable AI or XAI techniques in finance to make these models more transparent.
So you can understand the reasoning. Okay. Now, finance is heavily regulated. How does AI fit into that complex regulatory landscape?
It's a major consideration. Financial institutions can't just deploy AI systems in a vacuum. These systems need to comply with all existing financial regulations, rules around risk management, data governance, consumer protection, fair lending, and so on.
So the old rules still apply.
Yes, but regulators globally, including in Canada, are also grappling with whether new AI-specific regulations or guidelines are needed. They're actively developing frameworks to address the unique risks posed by AI, like the bias and explainability issues we just discussed. OSFI, for example, has been quite active in this space.
So the regulatory environment itself is evolving alongside the technology.
Constantly. Institutions need to stay on top of both existing rules and emerging expectations.
What about the models themselves? Are there risks associated just with how the AI models work? You mentioned model risk.
Yes, model risk is significant. AI models aren't static. They're trained on historical data, but the real world changes. Market conditions shift. Customer behavior evolves. Fraudsters adapt.
So the model can become outdated.
Exactly. It's called model drift. A model that worked perfectly 6 months ago might start making poor predictions or decisions if the underlying patterns in the data have changed. This requires constant monitoring, validation, periodic retraining of models, and really strong governance processes around model development and deployment.
It's not a set it and forget it's technology.
Definitely not. It requires ongoing care and feeding.
Thinking bigger picture, could widespread use of AI in finance introduce new systemic risks? Risks to the whole market?
That's a concern regulators are watching closely. For instance, if many institutions start using similar AI trading algorithms trained on similar data, could that lead to herd behavior?
Everyone rushing for the exits at the same time.
Potentially, yes. It could amplify market volatility or even contribute to flash crashes if algorithms react in unforeseen correlated ways during stressful market conditions. Understanding and mitigating these potential systemic risks is really important.
Right. Another risk, cybersecurity, but specifically targeting the AI systems themselves.
Yes, that's an emerging threat vector. AI systems themselves can become targets for attackers through what are called adversarial attacks. For example, an attacker might try to subtly manipulate the input data fed to an AI model to cause it to make a wrong prediction, maybe approve a fraudulent transaction it should have blocked. Or they might try to poison the training data to build hidden backdoors into the model, or simply try to steal the valuable model itself or the sensitive data it uses. Securing the AI pipeline is critical.
So protecting the AI itself is a new security challenge. Okay, one last big challenge, the one you alluded to earlier, the impact on jobs. What does this automation mean for people working in finance?
It's undoubtedly a major consideration. AI and automation will likely displace some jobs, particularly those involving repetitive tasks like data entry, basic analysis, certain types of customer support.
Which roles are most vulnerable?
Probably roles heavy on routine data processing, straightforward calculations, or handling simple customer queries. Back office operations, some analyst roles, maybe some call center functions.
But does it also create jobs?
Yes, that's the other side of the coin. It creates demand for new skills, people who can develop, manage, and interpret AI systems. Data scientists, AI ethicists, specialists in AI governance and risk management. But there's definitely a need for workforce adaptation.
Reskilling and retraining.
Absolutely. Individuals and institutions need to focus on developing skills that complement AI critical thinking, complex problem solving, creativity, emotional intelligence, managing human-AI collaboration. It's a transition, and managing that transition fairly is a key societal challenge.
Okay, we've covered a huge amount of ground, the applications, the tech, the potential, the challenges. As we wrap up, what's your concluding perspective on AI in finance as of April 2025? What's the big picture takeaway?
The big picture is that AI is no longer just experimental in finance. It's becoming core to innovation, efficiency, and competitiveness. It's fundamentally enhancing how institutions operate, detecting fraud, making investment decisions, managing risk, serving customers.
And specifically for Canada.
For Canadian institutions, embracing AI thoughtfully is vital. It's crucial for meeting complex regulations, fighting financial crime effectively, managing diverse risks prudently, and delivering the sophisticated services customers now expect.
And the future direction.
The trajectory seems clear towards even more hyper-personalization, more accessible financial tools, more proactive risk identification, and deeper automation. But, and this is a big breaker, but realizing that potential responsibly hinges entirely on tackling those challenges we discussed.
Privacy, bias, transparency.
Exactly. Privacy protection, ensuring fairness and fighting bias, achieving explainability, navigating the evolving regulations, managing model risk, considering systemic impacts, and addressing the workforce transition. It demands a strong ethical commitment and robust governance from everyone involved.
So the potential is massive, but so is the responsibility.
Precisely. If handled well, AI has the potential to contribute to a financial system that is more secure, more efficient, more accessible, and ultimately perhaps even more trustworthy. But it requires careful, ethical stewardship.
That's a fantastic summary to end on. This has been an incredibly insightful deep dive into AI in finance. It's clear the technology is moving fast and changing so much. We really hope this conversation gave you, our listener, a clearer view of what's happening, the key drivers, and what to watch out for as of April 2025.
It was a pleasure discussing it. It's a field that's certainly keeping everyone on their toes.
Indeed. A final thought for you to ponder. As AI becomes more embedded in our financial lives, from managing our investments to approving our loans, how does that change our fundamental relationship with and trust in the financial systems we rely on? Something to think about.
A very pertinent question for the future.
Thank you so much for joining us for this deep dive. And a big thank you to you, our listeners, for tuning in. If you found this discussion valuable and want more deep dives into important topics, please do subscribe and help our channel grow. We'll see you next time.